Hi guys, hi everyone, welcome. How are you guys doing? Are you guys trading on the US CPI rate later? Hi everyone, hi Chandrakan. And also, can I have a quick chat with my audience today? Anyone heard of this SMC concept before? Can you raise the hand? Hi Komsan, hi Abdullahi, hi Ram. Well. Great, I see Ram raise your hand. Hello, Eric. Today we're going to talk about SMC and hope that it will help you in your day-to-day trading. All right. We shall wait for a couple more minutes, okay, before we start. Hi, everyone. Hi, Dean. Yes, fair value gaps. Have you used it? Has it been effective for you, Dean? Hi, Montana. Well, I mean, ICT, he himself is a trader, so perhaps you can go to YouTube and then follow his video. So today this SMC concept is derived from the ICT. Okay, so hopefully it helps. Hi Mark, long time no see. We'll wait for just a couple more minutes. Yep. So see if any more people joining us today. Any of you guys here no plan to trade on the CPI reading later? Please be careful, yeah. And you guys can also feel free to share your thoughts in the chat box. If you have already predicted the CPI reading, will it be a high reading or a low reading? Hi, Kishan. So RAM is selling USD JPY pair. Kishan expecting for high reading. All right. Hi, Kingsley. So let's start. Before we start, let me read out the risk disclaimer for today's event. Yep. The information provided in this webinar is for educational purposes only and should not be considered as financial advice. The content presented in this webinar is based on information believed to be reliable, but not guarantee is made as its accuracy or completeness. PU Prime and I shall not help liable for any losses, damages, or expenses incurred as a result of the use of the information provided today. Trading and investing in financial markets involve a high levels of risk, and it is possible to lose all of your invested capital. Before making any investment decision, it is important to carefully consider your financial situation, investment objective, and risk tolerance. All trading and investment decisions are solely your responsibility. Participants should be aware of the risks involved and only trade or invest funds that they can afford to lose. Okay, this is the web risk disclaimer. So let's dive in. Okay, so today, as you can see on the screen here, today we're going to talk about the SMC trading strategies. All right, and this is the highlights for today. And in order for us to understand what is the SMC trading strategies, then we have some of the prospect we have to understand, and then we combine everything together so that you can have a basic concept of what is SMC. So what is all this about? And for you guys out there, if you are a experienced traders, you have been in the market for a while, so it should be okay for you, and I think you can be very quickly pick up, and then maybe you can relate some of the situations that happens in the markets. Okay, but if you are a new traders, perhaps it will be a bit hard for you to get it. All right. So yeah, let's start. So yeah, this is the elements that we are going to cover, some of the prospect. All right. Then let's start with the first one. So what is SMC, smart money concept? So smart money, we refer to institutional player. Okay, big player playing, trading with millions, if not multiple millions of dollars. And came from big platform, came from big companies that involve pretty much in the currency. Okay, we have to follow this big money. Any of you here, as a very normal retail trader, often we lose to them, or you think you can win against them? No, right? Because I think like hundreds of you here, we pull up the funds, you still can't beat a big bank, or let's say like Citibank, let's say like Bank of America, because they have billions in funds, and then if they want to move the market in one direction, they're allowed to do so, but we can't. Okay, if like I have $100 to trade, I have $1,000, I have $10,000 to trade, I still lose them. As my trading positions, my trading directions can't even move them little bit. So what we can do is we try to trace them, we try to follow them, we try to notice their footstep, their footprint, so that we can ride the same trend. Okay, this is what we're trying to do. Okay, we try to ride the same direction, the same trend as the big player in the market, the smart money, so that hopefully, as time goes by in the longer term, we can make more profit than we lost. Because you definitely can tell when we go against them, we'll definitely incur losses. We definitely cannot fight against them. So what is smart money concept is brought up by this ICT traders. And so in his opinion, so we should spot some of the footprint left when the smart money start to take it actions. Okay, when they act, they execute, they will left some footprint in the markets. Okay, either the price movement, okay, the price direction, or the trading volume. So from there, we can follow their trade. We cannot, it cannot be 100% true. It cannot be, it's not a perfect strategies. But what we can do is we try to mitigate our risk of losing, and we try to amplify the chance for us to make profit in every trade. And I can tell you here it's not very, very easy to spot, because in a market, when you look at it, the markets keep fluctuating. So it takes you, a long time or more. When you gain more experience, only you can have a clearer picture what is this all about. And then you can guess what are they trying to do, what are these big institutional players trying to do, and then we can follow them. Right. So before we know the big plan of the SMC concept, first we have to understand the market structure. So market structure here means that we have to at least understand in the bigger picture what direction the market is trading to, whether it is an uptrend or whether it is an downtrend or it just sideways. Okay, can anyone spot uptrend or downtrend here by far? I really hope that at the moment, all my audience here, all my fellow friends here, can able to spot it. Okay, if you are trading in a uptrend or you're trading in a downtrend in a bigger picture. Some of you, or me in the past, we try to act smart. We want to catch the reversal trend so that we can enjoy the entire trend. So when the market is moving in an uptrend, and then I just want to act like I'm very smart. I want to go against the market. Then I short it. Hopefully, this is the first candlestick that have the trend reversal, and then I dream that I can profit the entire downtrend onward. And then after so many years of experience, I found that this is wrong. So what I can do now is I follow the trend. When I see the trend is an uptrend, I follow. I will try to open the long position rather than a short position. And if really when the market has shown signs of reversals, only I act differently, only I change my direction. So here is when you want to trade with this SMC strategy, you have to at least know on which way the market is trading to, whether or not it's an uptrend or downtrend. So how can we tell on which direction the market is trading to? Is by spotting the highest levels and the lowest level of the trend. Whether or not this trend is forming a high level or this trend is forming a low levels. Okay, from there you can at least tell on which way the market is trading. Okay, I don't want to deep further down how to spot the uptrend or how to spot the downtrend. Okay, and here we have two very crucial idea here is break of structure and change of character. So what is break of structure? So break of structure is when in an uptrend, for example, when we spot the markets break its previous high. Okay, so when this particular asset break its previous high, means that this trend is an break of structure trend. Okay, and on the opposite, change of character is when the trends fail to continue its current trend. So for example, in an uptrend, when the markets fail to create a higher high and it break its previous low, it means a change of structure. Change of character. So this is two very crucial idea that you have to know, okay, in order to continue, right? So by far, anyone's got it? The break of structures and change of character. So this is, at least you have to know. Okay, this is the example of the break of structure. So obviously this is an uptrend. Okay, so this is, you remember I say break of structure is when this trend create a higher high. So when it create a high that higher than the previous high, here's the break of structure. Break again, break again, break again, break again. So this is a long-term uptrend price movement. Okay. So at least I hope that now you get this, right? And then moving on is the change of character. So it means that when this previous it was trading in a downtrend, okay, it means that when we trade in a downtrend, we are expecting a lower low. Right? See, when the break of structure, it means that it create a new low than the previous low, new low than the previous low, new low than the previous low, and until here midterm it failed after the new low, it break above the new high. Okay, no more lower low, but we have a higher low and a higher high. So at here it means that we now have a change of character. It means there's a trend reversal. Like like I said early, when I was younger, when I have a little experience, every time maybe when we first have this break of structure, they will try to catch a rebound trend. But sometimes you got lucky, you got TP, then you make money. But most of the time, if you trade against the trend, you know what, if I enter a short a rebound position, a long position over here, then I lose. So after I learn about SMC, and then I have to be more patient. So after that, I learned that only when this change of character pattern happens, only I start to trade differently, trade in a different direction, or else I will still stick to the previous trend. Okay, so this is very important. Okay. All right, and then moving on, we have to know what is the order block. So here is come to the key, because we want to learn from the institutional traders, right? We want to trade with the smart money. So when we can able to spot where is the order block, okay, then we know where is the cost price for the market maker, for the smart money. Okay. So how do we know where is the order block? Is when the first candlestick or the last candlestick of the previous trend. Okay, so take this as an example. When this is a chain of character, so over here will be the order block for the smart money. Okay, over here, the last candlestick before the trend reverse. Here it means that they captured a lot of liquidity here, and then will be their cost price for their positions, and then the trend reverse. So this is the bearish scenario and the bullish scenario. Both will have the order block. So some of the people here we trade with the order block strategy, but some of the people will trade with the fair value gap. You can debate. For me, either one is okay with the given situation. Sometimes order block is a better choice, but sometimes the fair value gap is the better choice. So I will talk about fair value gap later on, but now we talk about the order block. So when is the order block is valid? There's three I would say kind of important criteria. If you meet all these criteria, it means that this is a solid or valid order blocks that you can take it into account as a reference, so that you know where is your stop loss level. Okay, and it must create an inefficiency. So what is an inefficiency is that after the trend reverse, okay, after the trend reverse, we have the big we have let's say for example here the bullish scenario. After the price drop to here, and then have a trend reverse, start to rebound. Here's the order block. The next candlestick have to be a very long solid bullish candlestick. That is what we call the inefficiency, because when the market is efficient, definitely will have about the same amount of buyers, same amount of sellers. So the candlestick will more or less will be the same size. Okay, but when we spotted a very long solid candlestick, then it means that the market is inefficient. Means that a lot of order is not filled, right? So this is an inefficiency. So first criteria for a valid order block is it must create inefficiency. Secondly, it must have a break of structure or a change of character. So it's sometimes we over here, then we all have the order block over here. So it's either it has a break of structure or change of character. If it's not followed by these two price movement, it cannot count as a good order block. You cannot just simply draw everywhere when there's like a very short-term trend reversal, and then you can draw an order block. Then this is not true. So only when there is a break of structure or change of characters, only we can see it as a very solid or effective order block. And thirdly, it must be unmitigated. What it means is that after the trend reversal, right, and then we draw an order block, the trend must be continued for a while. It cannot just like bounce up and then go back down again, got hammered down, and then sideways there, only the trend continue. It cannot be mitigated. The trend have to be very obvious, very conspicuous, and very direct. So with that only, we consider it as a good order block reference. So if you want to trade with the order block, then you have to understand these three main criteria, and then you can put it as a reference. So next time when the price hit at the same price, that will be your stop loss and also your entry level if you are trading with the order block strategy. Okay. So moving on is the liquidity pool and also liquidity grab. So when you, because imagine you are the smart money and you have the big order, so where is your orders going to fill? So how many of us here is often, we got the direction correctly, but then we got washed away by the market before the right trend hits? Any of you here? For example, like 2-3 weeks ago when the USD JPY pair all the way going down, and maybe before that you already know UJ pair going to trade lower and lower, but then it just hit your stop loss, you lose all your positions. Only after that the market continues the downtrend. Or last week, for the gold market example, when it just sideways over there, and then now we all know it's now hitting its all-time high. But when it's sideways, you remember there's like a sharp, a quick drop before the uptrend. So this is, it relates to the liquidity pool and liquidity grab. So what is liquidity pool is that you and I know where is the support and resistance, right? We maybe, we probably have the stop loss and resistance at the same price level. Okay, me know, they also know. The institutional player should know. They should know where has the most sell order or buy order. So if they have the very big order and they want to meet their order, what they do, they will do it at the liquidity pool. So a liquidity grab is that they will purposely go to hit your stop loss, hit those support or resistance levels, hit your stop loss. That's why when you sell, they can buy, or when you buy, they can sell to meet their order, so that they after that the real trend will come after it. So when we know all these things, next time we have to be extra cautious. Okay, I don't know how you're going to do it. You want to give a longer buffer, or or you try to avoid, and then you try to, when you don't trade on a sideway, you don't trade when there is a very obvious resistance or support levels. That is, you develop your own strategy. But for me itself, this is very reliable. I always, because this makes sense to me. Because or else if you imagine if you have 1 billion worth of order, where are you going to meet your order? So here is where the big money, the smart money meets their order. Okay, I put this word over here. Your stop loss is my entry target. Sometimes we just got slaughtered like this without knowing. Okay, at least I hope that at least for now, some of you here know what happened when it got washed away. And after that, you got the correct trend, and then you were like, "Ayah, shit!" Right? So this is what happens. Okay, and then moving on, very importantly, is after we know the order block, and then just now remember I talk about the inefficiencies. This is what we call the fair value gap. Some of you here trade on the fair value gap. Some of you here trade on the order block. Both is fine. Okay, but then you can try it out which strategies suit you more and give you more win rate. Okay, then you just stick with it. Okay, so what is the fair value gap? As after the trend reverse, and then it have a very long solid candlestick, whether or not it's a bearish candlestick or a solid candlestick, it means that currently this candlestick show us that the market is inefficient. It means that a lot of order is not filled. A lot of order by retail is not filled, and the market, when it go back to restore its efficiency, for the price movement often will go back to this fair value gap. Okay, I'll give you an example later when I show you the chart. Okay, I'll pull out the charts. Okay, I just want to give you the idea is that it could be the institutional players want to take profit, or after it collects enough position and it create this an efficiency, it want to fill back to have more liquidity, and then the trend continue. Okay, so it's not 100% it will happen, because sometimes when there's a grab, but then the price just go all the way up or all the way down, and the fair value gap is not filled back. That could be possible. Okay, but just sometimes when you spotted this phenomenon happens, then you know we are now talking about SMC, we are now talking about the fair value gap. And then maybe you can try to trade along with this strategy. Okay, so it means that when the trend reverse, okay, and then we need at least 3 candlestick to spot a fair value gap. Okay, and then of course the same, we have to have some of the criteria to meet in order to know that this is a solid or valid fair value gap. So first of all, it's still the same, it's unmitigated. It cannot be, have a very long candlestick and then afterwards the next candlestick go back down, or have a long tail. That means this is not a very strong price movement. It have to be follow up, the few following candlestick have to go continue a trend, the trend. Okay, it means that it is not it is unmitigated. The trend is very strong. Okay, and then the next one is it is best if it confluence with the support or resistance level. So remember when I share with you guys this the breadth of structure or the chain of character. So when if you spotted FVG, okay, the fair value gap, and then when you draw a line here, it happen to be at the resistance level or support levels, then it will be a more reliable FVG for you for your reference. Okay, because when you spotted a FVG, and then later on, if you expect the trend, the price go back to the FVGs, right, and then you can enter. So and then you can set the stop loss level accordingly with the SVG, right, in the future. Then it will be more solid, more reliable for you. Okay, and yeah, it has to be confluence with the breadth of structure or chain of character. Same with the order block, because or else it will be just sideways, and also you don't know which direction it goes. Okay, it will be very confusing. We don't do that. Okay, that's why I say at the start of the webinar today is it takes a lot of time, it takes a lot of experience for you to know what is the breadth of structure, what is the chain of character, and where is the solid order block, and where is the solid fair value gap. Because in the market, you can tell it is not so obvious. Okay, we need to guess sometime, and it takes a lot of experience to tell. Yes, I will say this is definitely an order block. Yes, this is definitely an FVG. Okay, and the last one is FVG has to be, if it's more effective at the beginning of the trend. Okay, because FVG, sometimes in a big trend, we have a few long solid candlestick, right? So we have a few FVG, but if you use the FVG at the start of the trend, it will be more effective than when you spotted the FVG at the end of the trend. Okay, I hope that you understand what I say. Okay, so I'll try to take this BTC as an example. So this is like some others people's developed strategies. So this is not like 100% true SVG. Right, so here you see there's like a trend reversal, and then we have a chain of character where we have a higher high. So remember, like I say over here, we need 3 candlestick to spot our FVG, and then this is the when the trend reverse, and when we have a very solid candlestick, and between these 2 weeks, the first upper wick of the candlestick and the third lower wick of the candlestick, in between this level, here is the FVG, right? So what is the market is expecting that often the FVG will be filled. So you can see over here, there is a tail that is touched back to the FVG, and it's the same go to here. It go back, fill, and then continue the trend. So this is what we call we trade with the FVG. And if you are talking about the order block, it will be like this. When the first candlestick of the trend reverse, here will be the order block. Right? So sometimes it might fail, you know, sometimes when the trend can really just go all the way up, no filling back, then you miss out the chance. And sometimes if you trade with the order block, it can just, when you enter, drop all the way again. So, you know, this is no 100% sure a winning strategies for you, but then you just have to keep trying, or at least you know, you have to understand the market style, what the smart money is trying to play or to trade, so that we can follow the trend. Okay. Okay, and then moving on. So this is, I think most of the time we will spot this kind of behavior happens in the market. So I hope that I can clear to let you understand what the smart money, what the institutional player trying to do. Here is the downtrend, here is the uptrend. So have 3 steps. First is accumulating. So it often happens when the market is sideways, and then you will try to, after it collects enough position, okay, when all its wish size is already fulfilled, it will try to manipulate. Okay, it will try to wash away people. So if you let, for example, here is like a sideways, and then often many people will set their resistance level, I mean the stop loss level over here, expecting for a short position, and they will try to wash away people, try to have a failed breakout. So sometimes we call it the 2B price pattern. So this is where the manipulation happen. All right, and then distribute means the real trend come, and then so after it distribute, right, it will often create inefficiency, create a fair value gap. So now everything is linked, right? I hope that I make it clear. So when it distribute, when the trend is very strong into one direction, often some of the order is not filled, the order from the retail is not filled, or go just one directions, and the theory of the market efficiency is believed that the market will eventually go back to its efficiency. So that this is why we have this FVG here, and then also we hope that the price will go back to the FVG to fill all the unfilled order, okay, to restore the efficiency in the markets, and then the trend continue. This is also when the big player, the smart money, try to take profit for the first round, or just want to create more liquidity. Okay, because when there's the order, and then when there's the order fill, there is the liquidity. Because you only have buy order, there's no sell order, there's no liquidity. Same when there's only just sell order, no buy order, there's no liquidity. So when the big money want to restore the liquidity, it will often leads the price to go back to the FVG to fill the orders. And then when the liquidity is restored, then the trend will continue, right? So I think this 3 steps is very important. So sometimes you need to protect yourself, protect your funds. So you have to be aware, sometimes this manipulation can happen. It might lure you to the wrong direction, or it just want you to hit your stop loss, only the real trend come. So how many of you here making losses when this unjust or unfair price pattern happens? I don't know. I definitely hit by this game plan before. They play with this, and then I just lose all my money. Okay, I hope that I make it clear. So yeah, come to the last slide of this SMC concept is to I hope that this SMC can, at least if you don't use these strategies, but then when sometimes this thing happen, you can at least know this is the gameplay by the smart money, by the big player in the market, who often can decide the direction of the market, decide the direction of the gold, decide the direction of the oil. They have billion in their hand, they can make it. So what we can do, we just go accordingly with them, follow, ride their trend. Okay, so when we understand the SMC, when we spotted the trend, when we know the breadth of structure, when we know the trend of character, when we spotted their order block. So what we trying to do is we avoid to trade against them. Okay, when you know that there's already a trend reversal, when there's an order block, and when there is already a manipulation, we don't want to trade against them. We want to trade with them, right? And also the same, we want to have a better risk management. We set our stop loss accordingly. We set our TP accordingly. Okay, with the help of the order block, with the help of the FVG. Okay, at the end of the FVG, then we set our stop loss there, or at the end of the order block, we set our stop loss there. Hopefully, we can protect our position before the real trend come. Okay, and then after that, when if our stop loss level is not hit by them, and then hopefully when the real trend come, we can enjoy the entire trend. And lastly, it is also very important is we try not to fall into the trap, the liquidity grab, or sometimes we call it the false breakup. I think a lot of time it's happened before, when there's a sideway, and then sometimes we have a quick uptrend or quick downtrend just to hit our stop loss, or just lure us into a new position, and then it quickly go to the very opposite direction with a very strong move. Okay, I think if you in the markets for long enough, you will definitely see this kind of thing happen, and which is very, very unwelcoming, right? So yeah, here is the basic concept of this SMC concept. So I think it's very, very brief, and if you guys are very interested with this kind of topic, and if you want a part 2, or if you want we talk about like how can we equip ourselves with SMC, how can we trade with these strategies, you can let your account manager know, or can send email, and then we'll try to prepare for another round, part 2. I'll talk about then maybe some of the strategies from the ICT, right? And then we can discuss over here. And then of course, we hope that finger crossed can help you in your day-to-day trading, and help you to safeguard your funds, and then help you to amplify the chance of your profit. So yeah, at the end of the sessions, all your question is welcome. If you have any question, you can type in the Q&A, or you can just type it up in the chat box. So I know at the moment the US CPI is already unveiled. So I hope that some of you here no trading with the CPI. I hope you got the correct trend. Okay, if you are a swing trader, right? And also I forget to talk about this. The SMC often is more effective if you use a longer time frame, a daily time frame, or at least a H4 time frame. Because if it's too small, it is not very effective, and it's often used in the longer trade. Okay, in a trend trading. So if you are just a string trading, if a day trading, then it might not be so helpful for you. Right? So if you really want to practice with the SMC, remember try it with a longer time frame, right? Daily time frame, or H4. Okay, I don't advise you to go for like H1 or 30 minutes. Then it is not helpful. So any more question regarding the SMC? So if no questions, then here's the end of today's session. So I'll see you guys in the next sessions, right? Thank you guys. Thank you. Bye bye.